big story top of mind with everybody is what has happened in the last month or so in terms of oil prices. Big change for India, growth, inflation, current account implications. Let me first ask you for your broad analysis on how you are assessing how things have changed.
I mean, that's a fair question. It must be on everybody's top of their minds. Last time when I talked with someone in the media, I did mention that the impact obviously would depend not only on the level of the oil price, but its persistence. So we must remember that the new financial year hasn't yet started. So it may be possible that after a few weeks, oil prices do settle down at a range which is comfortable or tolerable for us. So that's a possibility which we cannot exclude. But should the current state of supply scarcity and constraints persist well into the new financial year, then I think the range of implications we need to think about is, number one, for example, if a commodity were to become supply constrained, do we want the prices to reflect its relative scarcity or make it lower from the point of view of its impact on disposable income and purchasing power? So there are two considerations there. The third consideration is, of course, the energy transition, focus on renewable energy, because this would also force higher blending of ethanol, which is a good thing. And of course, then there is a fiscal consequence if you lower the duties, because as you know, just a couple of days ago, the government did announce that the Garib Kalyan Yojana would be extended for 6 more months, and that is on a 6-monthly basis, it's about 80,000 crores. So annualized is 1.6 lakh crores. So these are all the multiple considerations. I can fully understand that different people would attach different weights to these considerations. So I would still think that we need to wait and see in the new financial year the persistence of the high oil price before the government thinks in terms of fiscal adjustments and balancing them out with price pass-through.
Okay, understood. Let me pick on that first part, which essentially is burden sharing to some extent, right?
Yeah, exactly.
Now, there, I think one consideration is that at this point in time, when inflation is already on the higher side, if you take into account our current comfort band, and you come out of a pandemic where incomes would have probably not completely been restored to pre-pandemic levels. At this stage, do you want to add that burden on consumption? Fine.
I mean, that's one way of looking at it, for sure. The other way of looking at it is, suppose the government does provide, let's say, hypothetically, duty relief in order to not fully offset, but at least partially absorb the price increase on the raw material cost. And if in the process government's borrowing rises, and then if therefore the bond market reflects that gets passed on to everybody, not just the oil users, the higher, because the government cost of capital is the benchmark. So that also is another layer of cost on the entire economy. So you have these multiple considerations. As I said, I can fully understand different people attach different weights to these considerations. Therefore, the final decision would actually depend on which of these factors would impinge on the economy more than the other or less than the other, and that would dictate the course of action. And there, I think it is possible the judgments can differ.
Understood. No, and that's fair. You talked about the fact that it's important to see the persistence. Actually, when this whole crisis started, most people assumed that a war of this nature probably won't last beyond days or weeks. We're already a month into this. At what stage does a decision become imminent?
No, that's difficult to say. I mean, I would personally think that if it lasted less than a quarter into the new financial year, it shouldn't have a lasting impact. For example, even 2 weeks ago, the prices dropped suddenly from 130 to 100 and then spiked to 120. And then after the news of Shanghai lockdown, it came down yesterday by another $10. It's incredibly volatile. Therefore, in these volatile situations, to make a policy decision that may or may not be reversible later is not the most advisable thing to do.
Sure. So on the other two sort of sides of it, the growth impact, but also the current account impact, how do you analyze that? One way or policy choices would probably shift between a currency adjustment, allowing for some rebalancing of the current account deficit widening. Alternatively, tighter fiscal and monetary policy being used.
Yeah, I mean, look, when you have a supply shock on the raw material, if you respond to them with a very tight combined fiscal and monetary policy, it's obviously going to have a big impact on growth. So you must let the currency take some of the adjustment. And I think our current account deficit, obviously, it will widen. And but because of the inherent uncertainty in making assumptions on the level and the duration of the oil price increase, it is difficult to say the extent of deterioration in the current account balance that we would face. But based on some assumptions about 100, 110, 120, I still think that the market's appetite for funding Indian current account deficit would remain relatively good. And if the current account deficit widens to somewhere between 2.5 to 2.8% of GDP, let's say, I mean, from where we are at this financial year end, which could be around 1.5, 1.6%, I still think on balance, it would be a manageable situation.
Okay. Will you share your calculus with us on scenarios? Say $100 per barrel oil for the rest of the fiscal year?
I think I would say, in general, if you have a persistence of oil price at $110 or above, then that would require some sort of a reaction, a burden sharing decision between the oil marketing companies, between the government, and between the consumer, etc. But if it is going to be 100 or below, I think it is manageable without upsetting the current arrangement.
Okay.